Let's review one more time what the auditor should do about fraud. First, the auditor should assess the risk that fraud could cause the financial statements to be materially misstated by going through a checklist of fraud risk factors. The risk factors are divided between two categories. 1, misappropriation of assets, and 2, fraudulent financial reporting. If a fraud risk factor is present, the auditor should look to see if there are any internal controls in place that might help to prevent or detect the fraud. If there are, or if the person has no opportunity to commit fraud, then there is no need to expand the scope of the audit by performing more tests. When controls are lacking, the auditor should audit more by expanding the substantive tests. When the auditor discovers fraud, the fraud should be reported to at least one level above where it occurred. If the fraud is material, the auditor should inform the audit committee. If senior management committed the fraud, no matter how inconsequential, immaterial, or material, the audit committee should be notified. Fraud is most difficult to detect when committed by senior management, such as the controller, as they have access to all documents and records and would not be questioned if they changed the records. Errors are mistakes, misinterpretations, and other acts committed with no intent to deceive. The difference between fraud and errors is the intent to deceive. The auditor's responsibility to detect fraud and errors is the same. The auditor should assess the risk that the financial statements could be materially misstated due to errors and fraud, and should design the audit to provide reasonable assurance of detecting such errors and fraud. The auditor is also concerned about whether or not the client committed illegal acts. The auditing standards define an illegal act as a violation of laws or government regulations. Auditors must differentiate between those illegal acts that directly affect the financial statements and those illegal acts that indirectly affect the financial statements. A direct effect illegal act causes the financial statement information to change. For example, bribing a customer to obtain business is an illegal act. When the client pays the bribe and debits some expense account and credits cash, the bribe has been recorded in the financial statements. The bribe now directly affects the financial statements. On the other hand, if a client is dumping toxic waste in the river behind the manufacturing plant, they are committing an illegal act, but it is considered an indirect illegal act, as they have not yet been caught. Nothing has been recorded in the financial statements. Auditors have no responsibility to design the audit to detect indirect illegal acts. Auditors provide no assurance of detecting indirect effect illegal acts. However, for direct effect illegal acts, the auditor must design the audit to provide reasonable assurance of detecting those direct effect illegal acts that could cause the financial statements to be materially misstated. No assurance for indirect illegal acts. Reasonable assurance for direct effect illegal acts. After all, an external auditor cannot be expected to even know all of the laws and regulations that a client may be subjected to, let alone audit for compliance. The auditor is auditing the financial statements. The auditor is not auditing for compliance with laws and regulations. What should an auditor do when they discover that illegal acts are being committed? The auditor should report the illegal act to the audit committee and ask the client to adjust the financial statements. If the client takes no action, the auditor must consider the implications of the lack of involvement and the impact upon the financial statements. Do you want to audit a client who does not care about whether or not the employees are committing illegal acts? I think not. When a client takes illegal acts lightly, the auditor will give great consideration to dropping that client from their client list. When an auditor detects acts that might be illegal, the auditor considers 3 factors. 1. Is it necessary to contact legal counsel? 2. Is the act properly reflected in the financial statements? And 3. What are the implications of the illegal act upon other areas of the audit? The following factors cause an auditor to heighten their professional skepticism about possible illegal acts. Unauthorized, improperly recorded, or unrecorded transactions. Client being investigated by government regulators. The client is known to have violated government regulations. Large payments are being made to unspecified consultants, affiliates, or employees. Excessive sales commissions. Unusually large payments made out to cash. Unexplained payments to government officials. Failure to file proper government forms such as tax returns. When the auditor discovers any of the above situations, they raise their professional skepticism by adjusting the scope of the audit. When I say an auditor adjusts the audit scope, I mean they should reconsider their assessed levels of audit risk and its components of inherent, control, and detection risk. The auditor should carefully consider the results of the substantive tests, and questions should be raised about management's integrity. While an auditor does not design special tests to find illegal acts, they constantly remain aware that illegal acts and fraud could be occurring. Some typical procedures used to detect illegal acts are as follows. Read the Board of Directors minutes. Ask the client if they have complied with the laws and regulations. Ask the client about the procedures they use to prevent and detect illegal acts. Obtain a management representation letter about illegal acts. Inquire of the client's attorney about such problems. Consider and evaluate the results of the audit tests of controls and substantive tests. Remember, the auditor must provide reasonable assurance of detecting those direct effect illegal acts that could cause the financial statements to be materially misstated. The auditor provides no assurance of detecting indirect effect illegal acts. However, let's face it, even if the client has been found to be committing an immaterial illegal act, we, the auditor, may not want to associate with this client in future years, as a small illegal act can soon become a large illegal act. Illegal is illegal. The auditor's primary concern about illegal acts is whether or not they affect the financial statements. If the illegal acts are material, management is asked to adjust the financial statements for the effects. If management refuses to adjust the financial statements, the auditor will issue a qualified or adverse audit report. If management stops the auditor from performing audit procedures to find out the financial statement effects of the illegal activities, the auditor then has a scope limitation. The auditor will issue a qualified or disclaimer audit report. Listen to the Audit Reporting CD for more information about the choices of audit reports, as reporting issues are frequently tested. There are 6 situations that would cause an auditor to be very concerned that possible illegal acts or fraud could be occurring. They are as follows. 1. The client's records are not readily available. What are they doing? Are they in the back room making up the schedules to support the numbers that they have reported? 2. The auditor develops certain expectations about the way analytical procedures, such as ratios and comparisons, should play out. When the results show drastically different numbers than the auditor expected, the auditor becomes worried. For example, if you think your client's gross profit percentage should be around 30 to 35%, and it turns out to be 72%, wow, maybe someone is cooking the books. 3. The auditor mails out positive confirmations, and no one replies, or the replies are very different than what the client has reported. 4. The subsidiary account balances cannot be agreed with the control total balances shown in the general ledger. 5. The client was asked if they knew about any fraud or illegal acts, and they said no. Then, when you begin testing their records, you discover fraud or illegal activities that they were aware of. And 6. Records are selected for testing and they are not available. It is said that the auditors should raise or heighten their professional skepticism when the above situations occur. Audit more, adjust your risk assessment, and reconsider your reliance on management's representations. Can you trust management?